Hey everybody, I hope everyone's doing well and had a good day today. This is going to be an end of day review for the Emini 5-minute chart for Monday, February 10th, 2025. And before I get into it, I'll put in the description the timestamp for when the review actually starts, but I wanted to start today's video just talking about some thoughts I had today, and I thought it'd be worth sharing. So I was thinking about systems and what systems really mean to me, because my idea for trading systems has changed from when I first started studying Al. I never even thought about creating any systems. I just thought if I could learn to read a chart well enough, I could trade based on what I see and how I feel, and that would be enough. So a trading system wasn't even in the equation. And then there was Systems Academy, and I thought, okay, I'm going to build a bunch of trading systems that I can deploy for basically any market, any part of the market cycle. I don't know, make dozens of systems to deploy. And that really, my idea of a system in that way has changed to something more broad. The way I think of it now, a trading system or a chart reading system, or really both, for me, I think they're more designed to keep me out of trouble and to protect me from myself and to keep me from doing very dumb things. The reason I thought of this today was because I was thinking about a day from almost 2 years ago now. Almost 2 years ago to the day, actually. And there's this day where, for me, personally, and for my account, however you want to put it, I guess I don't want to get into the specific numbers, but if we talk about percentages, at the time I lost, I want to say maybe 5% of my account in 2 days. And to me, that's huge. That's 2.5% a day on average. And, that was pretty bad for me. And I remember at the time I was trading based on my price action knowledge. And I remember feeling really confident with what I was doing because for the past week, maybe week and a half or 2 weeks leading up to those big losing days, my confidence was the highest it's ever been. The results were good. I was making a good amount of money every day. I felt confident. I felt calm. I felt happy. And I really felt like I made it, like I figured out trading. And then so I had those losses. And I still remember how the feelings I just said, confident, calm, and happy, all those feelings were ripped away from me in those 2 days. And then it felt like I was starting over from the bottom of a mountain that I can't even see the top of. Like, man, I thought I had it figured out. It was a false summit. I don't know anything. And those days have really stuck with me. I think everyone has some kind of days like that you really remember and you look back on, and I don't know how to put it, it might bother you what you did or what happened on that day. You had a bad day. Those days are really important. And even though it happened 2 years ago, I went back and looked at it today, and I just thought about it. And I looked back at what I did, the trades I took, and the management, all of it. And it really made me feel better diving deeper into that day again and thinking about how far I've come in 2 years. Because at that time, I had no systems and I had no risk control. And basically, I was confident because I was ignorant and I was just getting lucky. So in reality, those 2 losing days were sort of the best things that ever happened to me, because they were a combination of a wake-up call, but also there's a lot of learning lessons that I can derive from those days. So I wanted to talk a little bit about what systems mean to me now. Because again, I'm talking in a more broad sense, in general. A simple system, at least a simple system idea, might be don't trade the third leg. So if you can count 3 legs, don't trade leg 3. Wait for, depending on the context, you can expect a reversal, at least a minor reversal, if not a major reversal. So if it's leg 3, maybe fade it or just wait, don't take it. If you have, this day has pretty good examples. Like up here, you can count 3 legs up. 1, pull back, 2, pull back, 3, and then a bear bar closing on its low, bar 18. To me, I think it's better if you're long to just exit below bar 18, because there's too much of a risk of a move to the downside that could test all the way back down to bar 11, and who knows, maybe even deeper. So that's a simple system. You get 3 legs in one direction, and then an opposite bar closing strong against the trend. Just exit. And maybe you develop that into an entry in the opposite direction. But I think the overall important thing to know is just respect reversals after leg 3. Don't scale in to leg 3. So that's an example of one. And then just, I don't know, I'm trying to think about what else specifically on that day or those 2 days. Another thing I reflected on was the number of trades I took. And I think I had 24, something like 24 trades on one of the days. And for me, that's obviously over trading, because right now my goal is maybe, I don't even care if I take 1 trade a day. 1 to 3 trades would be fine, as long as they're high quality trades. So 24 is just ridiculous for me at this point. So looking back, it's obvious that I was over trading. Another thing was risk management, controlling my risk, controlling the downside. If I lost 5% in 2 days, it's obvious that, well, there's a couple of problems. One is that I was trading too big, and another is just, the reality is I was just getting lucky, so I didn't know what I was doing. And I want to keep this brief and keep this video as the review. But the point with all of this, what I really learned going back and looking at that day again, was I was basically trading recklessly. I had no guidelines to follow or to fall back on. And so a simple one to fall back on is trade leg 1 and don't trade leg 3. Or if you're in a trading range, buy low, sell high. It's these really simple things that are designed to prevent you from doing the dumbest things. Because when I look back at my trades on that day, some of them were similar to holding long even though you get bar 18 and just sitting through this drawdown, or getting out lower when you could have gotten out up here. And so what I discovered was the framework systems, like the general ideas, would have prevented me from doing a lot of the things I did on that day. Whether it was not taking an entry or the management decisions during the trade, the systems I have in place now would have saved me from the things I did then. And to wrap it all up, to bring it all together, what I'm talking about is, I think for a long time, for 2 years, I've had those days in the back of my head. and the feelings that were associated with those days. And I think what I did is I began to associate feelings of confidence with big losses. And that's not to say, let me put it this way, overconfidence is a problem in trading. I think that can be an issue. But there's a balance, because you do need to be confident in what you're doing. And you gain confidence through research and study and experience. But anyway, the point is, I was operating on confidence, but the confidence came from ignorance. And I've had 2 years since then to learn and grow and change the things I'm doing. And when I look back, I couldn't believe some of the trades I took or some of the management decisions I made. And that really opened up my eyes to, again, the growth I've made, but also the fact that what happened on those days literally cannot happen again as long as I adhere to my system guidelines. Because like I said, I look back at that day, and if I was trading then the way I trade now, with my systems in place, respect leg 3 reversals, buy low, sell high, the simple things to keep you from doing the dumbest things. If I was just following those rules, then those days, that stuff wouldn't have happened, or at least the damage wouldn't have been as big. And, that also gets into overtrading and position sizing. But the point is, I came away with the realization that the systems I'm developing now actually prevent days like that from happening again. So I don't have to move forward in fear, thinking, man, remember those days I felt so terrible. I felt, my confidence went from way up here at the ceiling all the way down to the floor. Or, I just felt whatever, all these negative emotions. It doesn't have to happen. And as long as I follow my systems, it's actually not going to happen. So that was it seems so obvious, but it's something I wanted to share. It was a cool realization. So with that, let's get into the review today. I won't get too much into these charts, the weekly and the daily, but the biggest thing to note is that we have a lot of overlap on these bars, and it's a tight trading range. Because of that, you can expect more trading range price action today. So I'm not going into the day expecting a big trend day in either direction. I'm not expecting that in general. I think something like, I really don't know the stats on this, but 60 to 80% of days have at least 4 hours of trading range behavior. And the stat I know better is that only 5% of days are small pullback trend days that last all day. So a bear trend day that starts in the upper left corner of the screen and goes to the bottom right, or a bull trend day that starts in the bottom left and goes to the top right. Those days are rare. So in general, those days are rare, and they're especially rare in such a tight trading range environment like this. What does that mean? It means you can expect breakouts to fail. So probably expect reversals and a lot of two-sided trading today. Okay, so going into the day, we have a gap up. We actually gapped above this high, bar 46 on Friday. And this was supposed to act as resistance, and it still might, because support and resistance is often imperfect. So it doesn't mean, just because we broke above this resistance, doesn't mean it's completely failed, because the bulls, if you think of the gap up as a breakout, the bulls are not getting follow through. Bar 1, we have a big bear trend bar closing near its low. And then bar 2, follow through for the bears. Bars 1 and 2, strong enough that we'll probably get a second leg down. Is it always in short? It might be, but after the big gap up, it's big up, big down. One thing I might be on the lookout for is a 50% pullback which is right here, there might be support at the midpoint of this gap up. And it depends on which prices you use, maybe from the close of Friday to the open of today. We'll do that. So here's the midpoint. Bars 1 and 2, strong enough down for at least a second leg. So minor reversal if we go above bar 2, likely. Better to sell above than buy above bar 2. And then bar 3, falling a little lower below bar 2, but finding buyers below. You can call it a micro double bottom with bars 2 and 3. What's important is to recognize that there's buying. There's buying into the close of bar 2. There's buying all the way into the close of bar 3. We're testing near support. So 3 consecutive bear bars, still second leg down, likely. The bears, maybe they're hoping for some kind of measured move, maybe of bars 1, 2 down to here, and maybe close the gap. But bar 3 is disappointing if you're a bear. If you sold below bar 2, which you're selling below a bar that had buyers into the close, so this might be the bottom of a channel or a developing trading range. But anyway, if you sold below bar 2, or even if you sold the close of bar 2, and bar 3 is your entry bar, you might be disappointed because if you sold below the bar, you're now holding a losing position. If you sold the close, you're at break even. But bar 3, not a credible stop order buy. Maybe it's a little bit higher probability on the open because opening reversals are common, but after three bars down, you can expect a minor reversal, sellers above 3, and a second leg down. Bar 4, we traded above 3, and now we have a bear reversal bar closing on its low. It's a low one short. What's the problem with bar 4? If you're a bear, if you're selling below bar 4, there's a couple of things. One, we have the support at the 50% pullback of the gap up, so the downside here might be limited. Also, if you're selling below 4, the market just rallied from the 3 low to the 4 high, and that's disappointing enough. And I want to reword that. That's enough of a trendline break to disappoint the bears. On a smaller time frame, bars 1 through 3 are a bear trend, and then the market rallied from the 3 low to the 4 high, breaking a bear trend line. If you draw a bear trend line from the highs of the bars, it's broken on bar 4. You can also just see the depth of the pullback. It's about a 50% pullback, the bar 4 high of the bear trend. Strong trends do not get 50% pullbacks. 50% pullbacks are common in channels and developing trading ranges. So we know the trend isn't as strong as it could be. And if that's the case, do you really want to sell a low 1 near the bottom of the trend? Probably not. You might prefer to sell a pullback. And that's what traders are doing. That's what we have on bar 4. Traders sold the 50% pullback. Now they might look to scalp out. Bar 3 low might be support. Like I said, we have disappointed traders who sold down here, now sitting through this drawdown, just hoping to get out at break even. So a low 1, you typically find more buyers below a low 1. Even though the bar itself is strong, the breakout isn't all that strong, and the context is following a big gap up, and we're still not below 50%. We're also on the open. Like I said, opening reversals are common. So as far as trading, as far as selling below 4, looking for trend resumption to the downside might not be very high probability. Bar 4, we went outside up. Bar 5, I should say. Strong enough bull bar, probably second leg up, likely. Tight trading range over the past 3 or 4 bars. But again, opening reversals are common. And at this point in the day, bar 1 is the high of the day. And you've heard me say it before. Bar 1 remains the high or the low of the day only about 20% of the time, which is about once a week. And if that's the case, then in general, there's a low probability that bar 1 here remains the high of the day. if it's going to remain the high of the day, the bears need to prevent the bulls from getting much closer to it because the bar 1 high is a magnet. So ideally, the bears create a good, strong bear bar on bar 6. The problem is that bar 5 is a second reversal up, so you have a reversal above bar 3, resumption attempt for the bears, and then a second reversal back up. And this might be more bears giving up, looking to sell higher, and then more bulls buying, maybe looking for a scalp, but then they see the entry bar and maybe they hold to see what they get for one more bar. The point is, if bar 1 is going to be the high of the day, the bears are hoping for a bear trend from the open. And then 6, the bulls get follow through. So outside up on 5 and then follow through buying on 6. Not as strong as it could be on bar 6 because bar 6, it's overlapping the prior bar by about 90%, maybe even more. So you know it's a trading range on a smaller time frame. And bulls were not willing to buy above bar 5. There wasn't that sense of urgency. How do I know that? Because of the tail on bar 6. When the bar closed on 5, the market fell and found buyers in the buy zone of the bar, rather than on the close or above the bar. It's good for the bulls that bar 6 closed on its high, because it might discourage bears from selling above it. And against a second reversal, which is good for the bulls, we're probably going at least a little bit higher. And there's really not a great sell signal. Bar 6, probably more buyers below. Bar 7, a big bull trend bar, breaking out to a new high. That's good for the bulls, but ideally the bulls want to see follow through because bar 7 did not break out far above bar 1. Maybe just, let's see, the high 60.82, the close 60.82 and a half. So we have a 2-tick breakout if you consider the close of bar 7 above the high of bar 1. So the distance is not very good. The bulls really want to see follow through here. Right now it's big down, big up, big confusion. The bears are going to sell above bar 1, betting on a trading range, and betting that breakouts are going to fail. So the bear breakout failed, we get a reversal. Bears sell, betting that the bull breakout will fail. But then the bulls get follow through on bar 8. And this is a big enough surprise, a strong enough rally, that a second leg up is likely. You have, like I just said, traders selling above bar 1, trapped on the bull breakout. You have bulls who doubted the breakout. They did not participate in the breakout. At this point, maybe it wasn't as high probability. Like I said, it was a 2-tick breakout, big down, big up, not all that clear. But then you get follow-through buying on bar 8, and it's a good follow-through bar, another big bull trend bar, closing at least above its midpoint and trapping traders below. So you have bulls who missed the trade because they did not participate, and they're looking to buy any pullback. You have bears who sold above bar 1, they're trapped into a losing position, and they're looking for a pullback to exit with a smaller loss. You also have bulls who bought the close of 7 or bought anywhere, but the probability was not yet high. And then we get follow through, the probability increases for the bulls. The bulls who had already bought wish they traded bigger, so they're also looking for a pullback to add on to their already winning position. This is the dynamic that is responsible for creating second legs after breakouts. So you get a bull breakout and follow through here. Now there's support below and second leg up likely. So with that, the first reversal attempt will probably be minor, probably buyers below the first pullback, buyers below these bars. So then we get bar 9. It's an inside bar. At this point, traders are wondering, is bar 9 going to be a failed bull breakout and a reversal back down? It's a high 1 buy, bar 9. Not a good signal bar. However, the flip side for the reversal, if you're a bear, are you eager to sell below bar 9? Probably not. Remember, if you're a bear, and let's say you sold above bar 1, you're just hoping for the market to retest the high of bar 1 so that you can exit your trade at break even. Bar 9, the reality is that bar 9 is not strong enough to undo what the bulls just did. So probably a minor reversal, second leg up, still likely. Bar 10, it's another inside bar, so consecutive inside bars. The market is contracting, the range is getting squeezed. It's a contracting triangle on a smaller time frame. And in this case, the bears are hoping this II pattern is a final bull flag. And maybe there's one more breakout to the upside, and then we get a major reversal, or at least a deeper pullback. But here, now the bulls are hoping this is just a continuation pattern. Because still, think about the flip side. If you shorted for any reason, you're still desperately trying to get out at break even or with a smaller loss. The bull breakout is strong enough for a second leg, and the bulls have not had their second leg yet. So still probably buyers below and minor reversal more likely. Outside bar on 11, the market tried to break out above and below the prior two bars. Outside bars are expanding triangles on smaller time frames, so it's not ideal to buy the high of a bull outside bar, and it depends on context. In this case, it might be an early bull trend, basically a high one buy here. But as far as selling below bar 11, it's really not ideal. The selling pressure is fairly weak. We have one bear bar in the past, maybe 8 bars. And the reversal still looks minor. Where's the strong trendline break of a significant trend line? Where's the consecutive big bear bars? They don't exist, so probably have to go higher to find sellers, which means bar 11 might be a better buy the close bar, because again, if you're looking to buy, which I think here it's always in long, you should be looking to buy, it's better to buy here than above bar 11, because bar 11 is an expanding triangle. So if you buy above bar 11, you're in effect, you're buying the top of a trading range if you buy above bar 11, which is not ideal. 12 bull trend bar, closing on its high, good for the bulls, and probably going at least a little bit higher. 12 is not a good sell signal. Bears may be looking for a second reversal, and at this point, the bulls basically have their minimum. They got a breakout, a pullback, and a second leg. So now, the bears are looking for a second reversal. But here, even if 13 is a strong bear bar, a 2-bar reversal with 12, it still might be minor. And whenever that's the case, whenever the opposite side has to do something really special to convince you, and by something special I mean something really strong, then you know the trend is relatively strong here. In other words, what I'm trying to say is it's always in long, okay to be long and hold long here. Maybe you exit below a reasonable second reversal by the bears, and you just wait and see what you get. 13, reversal bar, but bull close. It's not as strong as it could be for the bears. It also went to a new high, so the bulls broke out to a new high, and at this point it's a channel phase. By definition, if you can draw higher highs and higher lows, the market is in a bull trend. And if you connect highs, you know the market's in a channel. 13 is at least leg 2, leg 1, pullback, leg 2. What happens in the channel phase of a trend? In a bull trend, the bulls take profits at new highs, and the bears will sell for scalps. And the bulls will buy pullbacks. They'll buy below bars. They'll buy reversal attempts, betting that if it's a bull trend, 80% of reversal attempts will fail and become continuation patterns. But you can see what happened at a new high. Sellers at a new high. Not ideal to buy here, but 13, what's the flip side of 13? Is it a good stop order sell? No, it's a 3-bar bull micro channel in a tight bull channel. The context is bad for the bears. The stop order sell, not very strong. The reality is, there's probably buyers below 13, and the bulls might need one more leg up. 14, another doji, weak reversal attempt for the bears, so still probably a continuation pattern. Buyers below, and we probably have to go higher to find sellers. 15, outside up, but 15 broke out further below 14 than above 14, which means even though it's a bull outside bar, it has a bearish bias. And what you do with that information, that's something that I can't talk about in this video. It would just take too long. But that's something it's an idea that you can study. What happens when there's an outside bar that closes bullish but broke out below the prior bar further than it did above the prior bar. Just to do it quickly, bar 15 broke out one tick above 14, but it broke out a point and a half below. And you can clearly see it visually that 15 broke out further below 14 than above, which makes it more bearish. So you might have more sellers above bar 15. But then we get bar 16. And what happened? If you're expecting sellers above 15 and you get 16, then you know traders are trapped. That means the high of 15 might become resistance or might become support. You were expecting resistance, and if it fails, it becomes support. The problem here for the bulls is now we might be dealing with a late leg. 16, strong enough bull breakout for a second leg, but because it's leg 3, you're going to have a higher failure rate. And if you get any sort of bear bar, it might be better to exit below it. So even though 15, the high of 15 might be a good buy, the context isn't great because it's occurring in a late leg. So you don't necessarily want to buy the high of 15 on a pullback because we can get a deeper correction or even a reversal. Now you can see what happened on bar 17. 17 came very close to the high of 15 and then found buyers. But another inside bar on 17, and again 3 pushes up, 8, 13, and 16. And after 3 legs, you generally will expect 10 bars and 2 legs sideways to down. And because of the market cycle, it's a spike in channel bull trend. The channel began at the low of bar 11, and the start of the channel often becomes the bottom of a trading range. So the risk, if you're buying up here, the problem with buying up here, let's say you buy the close of 16 or 17, you're long up here, and maybe your stop is below bar 11. What's the probability we go up here before back down here? To me, after 3 legs and momentum stalling on 17, it's not all that clear to me that we're going way up here before we test down here. And because of the market cycle and what markets typically do, I would think there's a higher probability we test lower. And that's the problem with being long up here at this instant. So because of that, we might find sellers above 17, maybe even on the close of bar 17. And then 18. Looks like we tested the high of 17 and found sellers. So bar 18 is the bar that I'm talking about if you're long for any reason, but now you have 3 legs up and a bear bar closing near its low. It might be better to just exit below that bar and look to buy lower. And if you're flat, if you're a bear, you might look to sell below 18, or at least 1 times your risk, because that would take you to the bottom of what could be a developing trading range. Bar 18 is also a common time of day for a reversal. by the close of bar 18, there's an 80% chance you've seen the high or the low of the day. At this point, it looks like we've seen the low of the day, but as the price action develops, we may start to think, okay, maybe there's a 40% chance we've seen the high of the day, but with more information, that might become 50% or 60%. And the overall point with bar 18 is that I think it's a bar that you just respect and get out below it. You have consecutive buy climaxes. We're far above the average price. Obvious magnet below, bar 11 low, and a bear bar closing on its low. If you do hold long below 18, your stop has to be maybe below bar 7 or at the low of the day, somewhere down here. It has to be a wide stop. If your stop is below 11 and you're holding below bar 18, you're holding long. To me, this is more of a skunk stop. I'm expecting support down here. So if you're long, this might be an area to look to scale in. But even if you're using the wide stop, I do think it's worth exiting below 18 and reassessing. 19, an inside bar. We're testing the sell zone of bar 18. 18 is a breakout. 19 might be a breakout pullback. Bulls are hoping it's a failed bear breakout, but 18 is stronger than 19. Now we have 4 bars, more sideways. So after 3 legs up and two-sided, trading range price action, the probability is becoming closer and closer to 50-50 and getting better for the bears and worse for the bulls. So bull trend, but getting late in the trend, 3 legs up. And we might have to see, or we're expecting 10 bars and 2 legs sideways to down after 3 legs up. And that's why I think it's better to get out of longs up here. 20, bear breakout. The bar itself is weak, but it did break out a fair distance below the prior 2 bars, and it closed below the prior 2 bars. So even though 20 looks like a weak bar, it's a decent bear breakout. It's also a micro channel from bar 16. I want to just make sure of that. Yeah, so every high is at or below the prior high. And that tells me the first reversal, the first technical pullback, the first time the bulls trigger a stop above a bar, it's probably going to be a minor reversal. So probably sellers above 20 and a second leg down likely. It's also sort of becoming an endless pullback. If you were long for any reason, you get 15 and 16, you expect the second leg up. 19 was an attempt, but it failed. And if you were long on the close of 16, if you were very quick, and it depends on your level of disappointment. If you're long, say you buy the close, or you're long for any reason, and you get 17, how disappointed are you? It's a late leg, it's reasonable to exit at the high close, but if you don't there, 18 might be the bar that disappoints you, and then 19 doesn't give you that chance to exit at the high close. And then 20 going even lower. So it's becoming a problem for the bulls, and second leg down likely for the bears. 21 traded above the prior bar, minor reversal likely. We found sellers above the bar, second leg down likely, and probably going to test the bar 11 low. So we might have to go a little bit further before we find buyers. The bulls want a double bottom with 15, but is 21 a good signal bar? No. Fairly tight channel down, and 1 bull close in the past 5 bars. So the buying pressure, not very good. It looks like we need to go lower to find buyers, and then a give up bar 22. And you can see where the market vacuumed down to. The low of this bar, 60.81 3/4. The low of this bar, the same price. So we had a give up bar on 22, vacuumed down to the bottom of the trading range. Now this momentum might be strong enough for its own second leg down. This is a relatively tight channel with just 1 pullback. So if you're counting spike breaks, the first spike break was here on 21. It's 2 legs down, 1, pull back, 2. But it's a tight enough couple of legs that it might just be, well, we know it's 1 leg on a higher time frame, and we may get a second leg down. So even though we're testing support, you really need another reason to buy. And you can argue maybe it's a second leg trap, 1, pullback, 2, accelerating into possible support. But some traders might need more evidence before just buying the low of bar 11. 23, bull reversal bar, but still a tight bear channel. Minor reversal, more likely. The bar itself is good, but the context, not all that good because of the tight channel. This is more likely a minor reversal. The bulls will need to break a trend line and then retest the lows before there's any major reversal. 24, testing that trend line, reversing back down. If you bought above 23, you have a bad entry bar. You may just give up and look to buy lower. There's also the bar 1 high, which was tested on bar 11. It's getting tested again now. And traders are watching and we're waiting to see, is the support going to hold up, or will we break below it and will this become resistance? 25, breaking below the bottom of the channel, the bottom of the possible trading range. What's the problem with 25? Well, it might be a late leg. 1, pullback, 2, pullback, 3. So 25 is leg 3. We're testing support again, the bar 1 high. We are breaking below it, but the bears still need follow through here. What the bears have going for them is that this is a tight channel, and the first reversal will probably be minor. But you can call this a parabolic wedge. It's basically just unsustainable selling. We need some sort of correction, probably 2 legs, sideways, 2 up. So selling here, not ideal. We may have to test the top of the third leg, the 24 high. But at this point, it's probably always in short. The second leg down after this looks likely. 26 inside, bull trend bar. After 3 legs down, good for the bulls, but still within a tight bear channel. The bulls need to do more. They need a trend line break. And then 27, bad follow through. So bad entry bar for the bulls. For the bears, it may be a low 1 sell setup, but the signal bar is weak, following a bull trend bar. And I said after 3 pushes down, we probably need 2 legs, sideways, 2 up. And we might have 1 leg here on 26, maybe a pause, and then another leg up. The bears trying to get trend resumption. 28 is a variant of an outside bar because the high of 28 is at the same price as the high of 27, but the low of 28 is below the low of 27. So when that's the case, the bar behaves the same way as an outside bar. So that's why I call it an outside bar. And remember what I said earlier on bar 15. The same thing applies here on this one. 28 is an outside bar that broke out further below the prior bar than above. And that means I'm expecting resistance above 28, probably sellers at the high of the bar, more sellers than buyers below the bar. Testing the highs of the bars on 29. What about buying above 29? You can argue it's a second reversal, but it's occurring within a tight trading range after a tight bear channel. Big picture, the bulls might be arguing it's a big breakout, maybe a 50% pullback. And like I said, second reversal on 29, but inside of a tight trading range. For me, I'd prefer to wait for the breakout. And these bars are relatively small. Bar 18, bar 22. These bear bars are, and 25, these are bigger than 26 and 29. 30, another relatively small bar, breaking out of the tight trading range, but still within the range of 24. So we're still not out of this trading range. Consecutive bull bars good for the bulls, but the bulls still have to do more. Maybe they're breaking a trend line at this point, and that's good, but now we're expecting a retest before a major reversal or resumption up for the bulls. So tight bear channel, pullback, maybe need a second leg down first. Bar 30 is one of those bars where the bulls need one more bar, and it's not quite an always in flip here. So if the bulls need one more bar, they're probably not going to get it. You're going to have traders selling the close of 30, betting that they're not going to get it. And that's what happened on 31. 31, if you're long for any reason, it might be safe to just get out below 31. Too much risk that we start to get a second leg down. One, two-legged pullback, and then maybe two. And where are we testing? Who knows? Maybe there's the stop order sell below bar 4 that trapped traders. And who did that trap? Well, it traps bulls and bears. Getting trapped into a trade and getting trapped out of a trade are both valid signals. What I mean by that is, if you're a bull and you bought above bar 3 and bar 4 was your entry bar, maybe you just exit below 4 and then you get this rally and you were just trapped out of a trade. If you're a bear and you see the bear breakout low one short on 4, you sell below 4, you're trapped into a losing trade. So both sides are trapped here, and that creates a test magnet. And because we rallied here before, I'm expecting support, because we have bears who got trapped into a losing position. And if they're using a very wide stop, they sell here, they scale in, maybe after 3 legs up below a bear bar closing near its low. It's actually a good example of what happens with stop orders. And it's really cool to pay attention to stop orders for that reason. A bear sells below 4, trapped in a big way. They sell more below 18, scaling in, and here's their cost average, the midpoint. You can see 25 reacting to that price. But the reaction, the buying, was minor, and we had to go lower, or it looks like we have to go lower to find buyers, and that means we might have to go all the way down to the bar 4 low. So bear breakout and follow through, 32, possibly a measuring gap. Is it exhaustion? It might be, but as far as buying here, there's really no buy signal. This bear breakout will probably get a second leg down before there's any reversal. Now this video is getting pretty long. I like to just talk about maybe the first couple of hours or so, bar by bar, and I'll just speed it up here. Otherwise, I'll talk for hours. So bear breakout and follow through and more follow through, 33. But the tails on the bars are a warning. Why are there buyers into the close of 32? Why are there buyers into the close of 33? If you're a bear, that's disappointing. If you're betting on a bear breakout, you're betting on momentum, and there should be selling into the close of bars, not buying. It's a big second leg down, leg 1, pullback, leg 2, testing the bottom of a trading range. It looks like it came close to the bar 6 low. We're testing low in the day's range. And let me back up. I always like to look for measured move targets, and that's a more conservative target using the bodies. So the open of 30 or the open of 17 to the close of 25 placed on the high of bar 30. There's one target, and that's the safest target using bodies and then tails. And you can see the reaction at that price. And again, also testing low in the day's range. And let's back up. I like to look at it as if it's in real time. Bear breakout, pullback, second leg, but look to the left. So we know this is leg 2. Leg 1, pullback, leg 2. We also know that it's a trading range. Big up, or big down, you could say, big up, big down, and now we're low in the range. So when you have two legs down and you're testing the bottom of a trading range, if you're willing to sell, you need to be willing to, no, I need to rephrase that. If you're selling a leg two at the bottom of a trading range, what's your calibrated expectation? What do you really need to see for the trade to be working? You need momentum, which means you need bars closing at least near their lows. You don't want to see big tails below bars because you're taking a chance. Because we know that second leg traps are common in trading ranges. So we get this leg one down here, and it's comprised of three pushes. You could say 1, pause, 2, pull back, 3, or 1, pull back, 2, pull back, 3. Either way, 3 pushes but tight channel, minor reversal likely, second leg down likely. Well, here's the second leg, and the second leg is steeper than the first leg, and it only took 3 bars. Let's see. It took 3 bars for the market to move 13 points. Over here, it took 7 or 8 bars for the market to move that distance. So this is faster momentum. It looks like a stronger looking leg than the first leg, but strong looking second legs are common with second leg traps in trading ranges. So proceed with caution here. If you're selling, you need momentum, and the tails on these bars are a warning that this breakout isn't as strong as it could be. And the context isn't great. 2 legs down, bottom of a trading range. So you get bar 34. 34 might be your signal to close the position if you're short, and maybe even look to buy if you're flat, because it's a possible second leg trap. 2 legs down, bottom of a trading range. Bears need momentum to hold short, and they just got a bull bar after a pair of bear bars with buyers into the close. So this is not strong momentum, and that's what you need when you're selling at or near support. And then you can see a lot of traders bought on the close of 34. So after 2 legs down, inside bar, and a reversal, strong enough reversal up for a second leg. And 35 also closed above the 50% pullback of this bear leg. And that's a sign of strength for the bulls, and it's a sign of weakness by the bears. If the bears were really strong, the pullback would never reach 50%, never mind close above it. The bears try to reverse the breakout on 36, but 36 looks like a 50% pullback of the rally. And this one tested the 50% level, but could not close at or below it. It actually closed above it. And 36 was the second attempt, or I should say, maybe the third leg attempt by the bears. 1, pullback, 2, pullback, attempt at 3. But if you're a sell the close bear on 33, trapped on 34 and 35, you never got a retest of your close, the entry price down here, and you're forced to exit with a loss. That's what contributes to a second leg up. So 37, 38, 39, this is all one simple leg. There's been no spike breaks all the way to 39. So tight bull channel, even though there's a bear bar, you could say it's 2 legs up, but that's the same as saying this is 3 legs down. Minor reversal expected, but a bigger, in this case, second leg up. So 3 legs down, yes, but tight bear channel. Expect a minor reversal and a second leg down. 2 legs up for the bulls, expect a minor reversal and a bigger second leg up. So 39 is a weak stop order sell signal, buyers below. We got a second leg up. The second leg was strong enough that you can expect a minor reversal and maybe a third leg. And I want to back up and talk about this rally on the open. This entire rally is a breakout on a higher time frame. And even though it got a very deep pullback, we still got a higher low from 3 to 33. So the bulls are hoping for a retest of the highs up here. And because we got a higher low, you can argue this might be a very broad bull channel. Low, higher low, maybe a high, and a higher high later on. And you can see what happened when we tested the new high. Maybe it's leg 1, pull back, leg 2, pull back, leg 3, testing major resistance. So this becomes a sell zone. You have 3 pushes up, you have a major high, and then a tight trading range formed. And we eventually ended up getting the bear breakout. We have a bull trend line here, broken here, but not in a very strong way, and then broken stronger here, and then a weak two-legged rally to test the highs, and then we got a lower high major trend reversal for the bears. Again, I'm not going to get into the details of all these bars because I'll just talk for hours. So for stop orders today, I think it's reasonable to sell below bar 1, but bar 2, the big tail, not as good to sell below. And because opening reversals are common, you can be more aggressive on the open. I think it's reasonable to buy above bar 5, and then bar 6, reversal and follow through. You could buy above 7, betting that the bears need to do something strong to reverse this. And it's interesting too because, well, I think I talked about it earlier, but you have the bears who sold here, trapped on bar 8. You can see the market retest that price, and that leads to a second and a third leg up. So the II, you can call it a high 1, you could buy above bar 10, trading in the direction of the stronger trend. And then up here, not ideal to trade leg 3. So the next stop order, I think, is bar 18. Selling below 18 is a reasonable trade. Over here, not great. Tight bear channel and a tight trading range. So if you're buying above 29, 30 is really a weak entry bar. Even though it's a bull trend bar, it's even smaller than 29. Bar 29 is 3.25 points, and bar 30 is a point smaller. So I think 31 is a reasonable stop order sell for at least a scalp. I think 34 is a reasonable buy, possible second leg trap. Sellers need momentum, they're not getting it. Maybe you wait for higher probability, bull bar closing on its high, 35, and buy there, or 37. Either one works. And then a tight channel, continuing higher, 41, bull bar closing on its high. Nothing to sell, okay to buy for any reason. Up here, stop order is really not ideal in this tight trading range, and we're at the high of the day. You could sell below 70, betting on the lower high major trend reversal. I mentioned the bull trend line break, retest in the form of 2 legs, and then a bear bar closing on its low 70. But it's getting late in the day at that point. So that's about it for stop orders. So that's going to be it for today's video. Thanks everybody for watching, and I hope everybody has a good night.